What is the journey then for the fintechs looks when they have the initial funding?
That's a really good question. And I think a lot of startups don't necessarily think beyond that point, right? Especially people, the ones that are formed by younger folks who are sort of fresh out of college. You get into the startup lifestyle, you build something, and all of a sudden you get some venture capital attention. Maybe you get a seed round or a series A, and all of a sudden you have this valuation, right? You get a series A and they say, here's how much money we're giving you and this valuation. And all of a sudden there's a number attached to the value of your company. And this is a really difficult moment for a fintech startup because having that number, let's say you got a $5 million series A and somebody slaps a valuation of $150 million on you. That's awesome, right? It means that there's somebody who loves what you're doing, but at the same time, that money figure can really go to your head. And so you look and say, oh man, that's cool. I built this thing that's worth $150 million. Well, you haven't really yet, right? Somebody is giving you money with the idea that maybe you'll get to that point. But if you talk to venture capitalists, they give money to companies and don't necessarily expect all of those companies to pay off. In many cases, don't even expect a majority of those companies to pay off. I've talked to venture capitalists who say we have a 5 to 10% hit rate, meaning 5 to 10% of the companies that we invest in will go on to become something really huge. That's not something that fintech founders feel. When you think, oh, I've got this $150 million valuation, what the VC is saying is, we think there's maybe a 10% chance you'll get to that valuation. And so we're putting this money into you because if it pays off, it's really going to pay off for us. What a founder might hear is, we've already done it. We've already made it. And so this is a moment where discipline is really key.